In this video, I will explain what a liquidity run and a liquidity sweep are. I will explain the key difference between them and the correct way to identify each one, so you can determine whether it's a reversal or a continuation. So let's get into it. One of the biggest misconceptions in ICT trading is the belief that once liquidity is taken, an entry is automatically valid. Traders see a clean liquidity sweep, equal highs taken, stops cleared, sometimes even displacement starting, and they assume that continuation, and therefore entry, is guaranteed. But this assumption is where a large number of ICT traders lose money. A liquidity sweep does not validate an entry. A liquidity sweep only tells you what was removed from the market. It does not tell you whether the market is ready to continue or whether an entry is justified at that moment. This is where most traders get trapped. They correctly identify the sweep. Their directional bias is technically correct, and yet the trade still fails. Not because the liquidity sweep was wrong, but because entry was taken without confirmation. In this video, I want to clearly separate two things that are often confused in ICT trading: liquidity being taken and an entry being validated. I'm going to walk you through a real chart example where liquidity is clearly swept, but entering immediately after that sweep is the wrong decision. We'll break down why the sweep alone is not enough, what was missing at the execution level, and how ICT distinguishes between a liquidity sweep that leads to a valid entry and a sweep that simply leads to further manipulation. The goal here is not to tell you to stop trading liquidity sweeps. The goal is to help you understand when a liquidity sweep does not validate an entry, even when your analysis looks correct on the surface. Because once you stop assuming that every liquidity sweep is an entry signal, a lot of unnecessary losses disappear. Let's break this down on the chart. First, let me slow this down and explain this diagram properly, because this is where most of the confusion around liquidity sweeps comes from. In the first example, what you're looking at is a clean and valid reversal scenario. We start with sell-side liquidity being taken. Price runs below these equal lows, stops are cleared, and weak sellers are removed from the market. But notice what happens after that liquidity is taken. We don't just assume reversal. The market gives us confirmation. We see a clear market structure shift. That structure shift comes with real displacement, meaning price moves away with intent, not hesitation. Inside that displacement, we get a fair value gap, which tells us imbalance was created and price moved aggressively. Now, when you put all of this together, liquidity taken, structure shift, displacement, and imbalance, the market is clearly communicating a change in order flow. In this first case, the reversal is justified. This is not a trade taken because liquidity was swept. It's a trade taken because the market confirmed the reversal. Now let's move to the second example, because this is where things start to break down for most traders. In this second scenario, we once again have sell-side liquidity taken, and this is where the problem begins. Subconsciously, almost every trader immediately expects a reversal here. Why? Because for years we've been conditioned to believe that after sell-side liquidity is taken, we should buy, and after buy-side liquidity is taken, we should sell. This belief becomes automatic. Traders stop waiting for the market to speak and start anticipating what they think should happen next. But liquidity does not tell you direction. Liquidity simply tells you where orders were resting. It tells you what has been removed from the market, not what the market intends to do next. And this distinction is critical. Now, look carefully at what happens after liquidity is taken in this second example. Yes, we do get something that looks like a market structure shift. But this structure shift is weak. There is no real displacement. Price does not move away with urgency. It hesitates. It overlaps. Objectively, this is not strong confirmation. But because traders are already expecting a reversal, they begin to trust this weak signal. They elevate it in their mind. They convince themselves that this confirmation is high quality, not because it actually is, but because it aligns with their expectation. This is one of the most dangerous things you can do in trading. You start judging confirmation based on belief, not based on price behavior. Instead of asking, "What is the market telling me right now?" traders ask, "How can I justify the trade I want to take?" Now watch what happens next. As price continues, it takes this high. And at this point, the market reveals its true intent. We get a structure shift in the opposite direction. A bearish structure shift. And this time, notice the difference. This move comes with clean displacement. Price moves away decisively. There is no hesitation. There is no overlap. An imbalance is created. From an ICT perspective, this is the real confirmation. But most traders do not trust it. Why? Because they are still emotionally committed to the idea of a reversal. Even when the market clearly communicates continuation, they ignore it, simply because it doesn't match what they expected to see. This is where most losses come from. Not from liquidity sweeps, not from ICT concepts, but from forcing a narrative onto the market. If instead of relying on beliefs, we follow what the market is objectively telling us, we can eliminate a large number of unnecessary losses. Liquidity sweeps are not entry signals. They are areas of interest. Direction is determined after confirmation, not before. And if we take the trade based on this confirmed bearish structure shift, instead of forcing a reversal, this is how the trade actually plays out. Now that you understand the logic using a simplified diagram, let me show you some real chart examples where this exact mistake happens and how applying this framework changes the outcome. Coming onto the charts, you can see a clear buy-side liquidity sweep. If you only look at this local range, the sweep appears genuine. And this is where most traders get trapped. After a liquidity sweep, everyone expects a reversal. Naturally, traders expect price to move lower and take these lows after sweeping the buy-side liquidity. Now let's see what happens if we actually take a reversal trade from this buy-side liquidity sweep and target these lows. You can clearly see that price never takes those lows. Why? Because only the 15-minute time frame is suggesting bearishness. When we shift to the 4-hour time frame, the narrative is completely different. On the 4-hour time frame, price is clearly respecting this fair value gap, which tells us that the overall order flow is bullish. There is not a single valid price signature indicating a bearish move. No bearish displacement, no structural shift, nothing. So instead of forcing a reversal trade, the smarter approach is to wait. Let price retrace back into discount, sweep some sell-side liquidity, and fill inefficiencies like fair value gaps before continuing higher. And in this scenario, you can clearly see that price does exactly that. It trades into discount, fills the fair value gap, sweeps these lows, and then gives us a clean opportunity to enter in alignment with the 4-hour time frame bias. Now, if we take that trade and target these highs, as suggested by the 4-hour time frame, look at what happens next. Exactly as expected, price moves straight into our targets. So what I'm trying to say is this. Stop relying on the idea that after every liquidity sweep, there has to be a reversal. The market does not move based on fixed patterns or assumptions. Instead, rely on price signatures. Price will always tell you what it intends to do if you know how to read it. Always give more importance to the higher time frame narrative. Let the higher time frame decide the direction, and use the lower time frame only for execution. When you align yourself with what the higher time frame is telling you, you stop guessing, you stop forcing trades, and your execution becomes clean and consistent. Now let's look at how real reversals are actually formed, and more importantly, how to identify which reversals are worth trading and which ones should be ignored, because not every liquidity sweep leads to a reversal, only the ones that are aligned with the higher time frame narrative do. If you look at the 4-hour time frame first, you can clearly see multiple bullish fair value gaps. And the important thing here is not just their presence, but the fact that price is consistently respecting them. Every time price trades into these bullish fair value gaps, it reacts strongly, which tells us that higher time frame order flow is still bullish. Along with that, you can also see that sell-side liquidity has already been swept earlier, and that sweep has already resulted in a bullish reaction. That means a higher time frame reversal has already occurred. Price then goes on to generate new lows internally, and instead of chasing price, we wait. We wait for those internally created lows to be taken. Now, once price comes down and sweeps those lows, this is where we shift our focus to the lower time frame. Here you can see a clean liquidity sweep. At this point, because our lower time frame is now aligned with the higher time frame bias, we can actually look for a reversal entry with confidence. So let's take that reversal trade. And notice what happens next. Price expands aggressively and moves straight toward the 4-hour highs. No hesitation, no consolidation, just clean continuation in the direction of the higher time frame draw on liquidity. This is the key point I want you to understand. If your lower time frame bias is aligned with your higher time frame bias, if your 15-minute narrative matches what the 4-hour time frame is telling you, then after those liquidity sweeps, you should expect full reversals. That is when reversals work. But if there is no alignment, if the higher time frame is bullish, and you keep shorting every buy-side liquidity sweep on the lower time frame, you will get stopped out again and again. You will feel like nothing works, not because the model is wrong, but because you are trading against the narrative. That's why understanding price signatures is critical. Price always communicates its intentions. If price wants to go bearish, it will respect bearish PD arrays, bearish fair value gaps, premium levels, and it will not hesitate moving lower. You will see strong expansions and constant reactions. And the same applies on the bullish side. If price is bullish, it will respect all the bullish PD arrays. It will trade through discount efficiently, react from fair value gaps, and it will not hesitate going higher. Expansion becomes clean and aggressive. So stop memorizing patterns and start reading price. When you understand what price is telling you, reversals become obvious, and you stop forcing trades that were never meant to work. As you can see here, price takes buy-side liquidity, and at the same time we have a generally bearish order flow. At first glance, this buy-side liquidity sweep looks like a very good reversal point. Most traders would immediately start planning a short trade from this area, and this is exactly where the problem begins. When you see a liquidity sweep, you do not need to become biased toward any direction. A liquidity sweep by itself does not mean price will reverse. You must always depend on market structure and what price is actually doing on the lower time frame. In this case, the buy-side liquidity sweep does not give us any real confirmation of a bearish reversal. Now let us move to the lower time frame and see if there is any structure that supports a short trade. Here we can identify the last swing low that price would need to displace in order to confirm bearish continuation. This is the key level we should be watching, not the liquidity sweep itself. As price moves toward that low, you can see how it reacts. Price strongly rejects from this level. At first, this reaction may even look like a sell-side liquidity sweep, but you do not need to overcomplicate it. All you need to do is observe how price reacts around short-term highs and lows. This rejection from the low clearly tells us that price is not willing to move lower. Because of this rejection, the probability of price continuing downward is now significantly reduced. Instead of forcing a short trade, we now shift our focus to potential long opportunities. At this point, we get a clear change in state of delivery, followed by the formation of a fair value gap and an inverse setup. This gives us proper confirmation to look for long entries. From here, we can enter the trade comfortably with confirmation, place our stop loss just below the recent low, and target a fixed risk to reward. In this example, the target was set at 1 to 3 risk to reward, and as you can see, price moves cleanly in our favor. This example clearly shows why you should never assume direction based only on a liquidity sweep. Let price confirm its intention through structure and reaction, and then align yourself with what the market is actually doing. That's it for this video. I hope this breakdown helped you better understand liquidity, entries, and why trades get stopped out, and that it improves your overall trading performance. If you found value in this video, make sure to like, share, and subscribe for more ICT concepts, market structure, and real chart breakdowns. You can also join my Discord trading community for daily discussions and learning. If you're interested in mentorship or prop firm discount offers, all the links are in the description below. Thanks for watching, and I'll see you in the next video.